Hello, we are from Fortune China Real Estate Investment Limited. We are helping the company to decide whether to buy or rent an office. We conduct the following cash flow analysis to compare the NPV and IRR for two cases. And in both cases, we assume the same budget and we choose the property, the center is central. From our analysis, we should rent an office rather than buying as it is more viable business option. We are going to explain our analysis below. Let's start with the first case, the assumption for buying an office. The price per square feet is Hong Kong dollar 32,000 at year 0 from Centrelink Commercial. So the initial budget is 320 million Hong Kong dollars. The current rent is 75 per square feet. According to the rating and valuation department, the percentage growth in the office rent is 6.5% for the first 10 months in 2017. And we predict by the end of the year 1, there will be an 8% growth in the office rent. We assume the same momentum will continue in the following 2 years and will gradually increase at a slower rate of 6% for year 4 and 5, then 5% for year 6 and 7. Based on the market transaction price of 75 per square feet, we sign a 3 years fixed rent contract with the landlord. From the year 4 to 6, the rent will increase to 100 per square feet, and by the year 7, it will be 117 Hong Kong dollar. An important factor that affects the NPV of case 1, buying an office, is the capitalization rate. Year 1 cap rate is taken as a current market yield of Grade A office in Hong Kong. It will gradually increase to 4.3% in the year 7. That is mainly result from the US interest rate hike cycle.
Let's move on to the cash flow analysis. In year 0, buying an office would generate a cash outflow of 320 million. Together with transaction costs such as stamp duty, lawyer fees and commission, which is about 10% of the transaction price. Net cash flow is about negative 352 million. From year 1 through year 7, management fee of 1.2 million is expected annually. In year 7, we are disposing of the property, generating a net cash inflow of about 327 million, which is determined by the rent at year 7 divided by the terminal capitalization rate of 4.3%. Afterwards, we discount the aggregate net cash flows by the WACC of 5.91%. 5.91% is derived from the average WACC of 18 real estate companies listed according to Bloomberg. And the WACC is chosen as our discount rate because it took into consideration of both the required rate of return of debt and equity holders. From these inputs, we obtain a negative NPV of 142.4 million with a net IRR of negative 1.56%.